landscape has changed since our last World Economic Outlook update in January. We're entering a new era as the global economic system that has operated for the last 80 years is being reset. Since late January, many tariff announcements have been made, culminating on April 2nd with near universal levies from the United States and counter-responses from some trading partners. The US effective tariff rate has surged past levels reached more than 100 years ago, while tariff rates on the US have also increased. Beyond the abrupt increase in tariffs, the surge in policy uncertainty is a major driver of the economic outlook. If sustained, the increase in trade tensions and uncertainty will slow global growth significantly. Reflecting this complexity, our report presents a reference forecast which incorporates policy announcements up to April 4 by the US and trading partners. Under this reference forecast, global growth will reach 2.8% this year and 3% next year, a cumulative downgrade of about 0.8 percentage point relative to our January 2025 WEO update. Our report also offers a range of forecasts under different policy assumptions. Under an alternative path that excludes the April tariff announcements, global growth would have seen only a modest downgrade to 3.2% this year. We also use a model-based forecast to incorporate the temporary suspension of most tariffs announced on April 9, together with the increase in bilateral tariffs between China and the US to prohibitive levels. This pause, even if extended permanently, delivers a similar growth outlook as our reference forecast, 2.8%, even if some highly tariffed countries could benefit. Now, while global growth remains well above recession levels, all regions are negatively impacted this year and next. And the global disinflation process continues, but at a slower pace, with inflation revised up by 0.1 percentage point in both years. These trade tensions will greatly impact global trade. We project that global trade growth will be more than cut in half from 3.8% last year to 1.7% this year. The tariffs will play out differently in different countries. For the United States, the tariffs represent a supply shock that reduces productivity and output permanently and increases price pressures temporarily. This adds to an already weakening outlook and leads us to revise growth down by 0.9 percentage point to 1.8%, with a 0.4 percentage point downgrade from the tariffs only, while inflation is revised upwards. For trading partners, tariffs act mostly as a negative external demand shock, weakening activity and prices, even if some countries could benefit from trade diversion. This is why we have lowered our China growth forecast this year to 4%, while inflation is revised down by 0.8 percentage point, increasing deflationary pressures. All countries are negatively affected by the surge in trade policy uncertainty as businesses cut purchases and investment, while financial institutions reassess their borrowers' exposure. Uncertainty also increases because of the complex sectoral disruptions that tariffs could cause up and down supply chains, as we saw during the pandemic. The effect of these shocks on exchange rates is complex. The tariffs could appreciate the US dollar, as in previous episodes. However, greater policy uncertainty, lower US growth prospects, and an adjustment in the global demand for dollar assets are weighing down on the dollar. Risks to the global economy have increased and are firmly to the downside. First, while we are not projecting a global downturn, the risk it may happen this year have increased substantially from 17% projected back in October to 30% now. An escalation of trade tensions would further depress growth. Financial conditions could also tighten as markets react negatively to diminished growth prospects and increased uncertainty. On the flip side, growth prospects could immediately improve if countries ease from their current trade policy stance and promote a new, clear, and stable trade environment. Addressing domestic imbalances can also help raise growth while contributing significantly to closing external imbalances. For Europe, this means spending more on public infrastructure to accelerate productivity growth. For China, it means boosting support for domestic demand, while for the US, it means stepping up fiscal consolidation. Turning to policies, our recommendations call for prudence and improved collaboration. Let me outline some key ones. First, an obvious priority is to restore trade policy stability. The global economy needs a clear, stable, and predictable trading environment, one that addresses some of the long-standing gaps in international trading rules. Monetary policy will need to remain agile and respond by tightening where inflation pressures re-emerge while easing where weak demand dominates. Monetary policy credibility will be key, especially where inflation expectations might de-anchor, and central bank independence remains a cornerstone. Many fiscal authorities will face new spending needs to bolster defense spending or to offset the trade dislocations likely to come. Some of the poorest countries, also hit with reduced official aid, could experience that distress. Yet debt levels are still elevated, and most countries still need to rebuild fiscal space, including by implementing structural reforms. Support, where needed, should remain narrowly targeted and temporary. It is easier to turn on the fiscal tap than to turn it off. Where new spending needs are permanent, as for defense spending in some countries, planning for offsetting cuts elsewhere or new revenues should be made. Finally, even if some of the grievances against our trading system have merit, we should all work towards fixing the system so that it can deliver better opportunities to all. First, on the revision for growth in the UK and inflation. So the tariffs are playing a role, as they are in most countries, and uncertainty is also playing a role, as it is in all countries. And it's weighing down on growth in the UK. But there are some UK-specific factors, and I would say that in terms of the 0.5 percentage point downward revision that we're seeing for the UK, the domestic factors are probably the biggest ones. And in particular, there is a lower carryover from weaker growth in the second half of last year. There is also some tightening of financial conditions as interest rates have risen, longer-term interest rates. On inflation, the revision in inflation in the UK is coming from domestic factors, and in particular some change in regulated energy prices. So that's expected to be temporary, but it's also very UK specific. The effect of the tariffs on countries like the UK, like it is on the EU or China, is like a negative demand shock. It's weakening activity, but it's also lowering price pressures, not increasing them. Now, what is the impact of the tariffs in the medium and long term? Not just what's going to happen this year or next, but what's going to happen longer term. Our assessment is that it's going to be negative. We have a box in our report that looks at the long-term impact of the tariffs if they're maintained, and it is negative for all regions, just like the short-term impact. So we're seeing a negative impact in the short term, in the medium term, in the long term. Again, there are nuances. Some countries might benefit depending on the particular configuration of tariffs, might benefit from some trade diversion, but the broad picture is it's negative for the outlook. Now, and I will end with that, our forecast for 2025 is slightly higher than OBR's forecast. Some of this has to do with some of the underlying monetary policy assumptions. For the UK, the bank, our assumptions for this year is that there are going to be 4 cuts through the year. 1 cut already happened. We expect 3 more.
We are indeed expecting a slowdown in growth to 1.5 this year. And this, to a large extent, is kind of the natural slowing of the economy after growing quite robustly in previous years, and also as a result of policy tightening that we've seen both on the fiscal as well as on the monetary policy side. It is also due to the lower oil prices that have come about as a result of the as a response to the to the round of tariffs, as well as the uncertainty about global growth. So all these factors are behind that lower growth number, although I should point out that it is actually a slight upward revision relative to what we had back in January. And the reason for that is that, again, we actually had seen upward surprises in 2024, which kind of carried into 2025. When it comes to the medium-term growth outlook, we do expect that to be relatively weak. We have penciled in growth number of about 1.2, which is down from 1.7, which is what we had before the start of the war.
So regional growth in sub-Saharan Africa improved significantly last year to 4%, and it will ease in 2025. And this is in line with a softer global outlook. And so we are seeing the same forces at play in the region as we are seeing more globally, and a downturn and a downward revision in our projection that is of the similar magnitude at about 0.4.
On the demographic shifts, our chapter 2 basically points out that countries' age structures are evolving at different rates. As you pointed out as well, we have most Western economies, some Asian economies that are aging fast, and in a healthy way, some of them. And then we have many sub-Saharan African countries that have a very young population. And what the chapter shows is actually there are important medium-term consequences of that, both for growth as well as external balances of countries. In Africa's case, basically what we would see is a demographic dividend coming from having a young population. And the question then becomes how best to leverage that, how best to use that and channel it into growth. And the answer there, first and foremost, depends on the structural reforms, the investment that's necessary on healthcare, on education, on human capital more generally, and also international cooperation, because our chapter 3 looks at more carefully onto migration flows. And again, there we see that migration policy shifts in destination countries has spillovers for other countries, and this is especially true for emerging market economies and lower income economies. So again, international cooperation there, making sure that the growth dividends are utilized in the best way. This is what we delve into in the chapter.